to think that we would get through that without some turbulence, I think is overly optimistic.
Yeah.
And so the real thing to, the key takeaway out of this is, just as things were going incredibly well and you can't get overly excited, when there's indicators of potential recession, you can't get overly excited, just to remain level-headed throughout the entire time period.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, I am excited. We are here and we're at a new office, so new location for the podcast.
Andrew, we are in a new office. I think the acoustics are a little bit better. The surrounding area is a little bit better for us anyway. Maybe not for the viewers because you can't really see out the glass window. It's just the wall behind us. But it feels good, and hopefully we sound even better when we're bringing value to our listeners and our viewers.
Exactly right.
Andrew, run us in. What are we talking to everybody about today?
So today we're back again with another market wrap. I think it's been a little bit since we've done one, so we're going to do the rounds and see what's been happening in investment markets around the world for the last month or so.
I think it's absolutely timing in terms of what we're going to talk about, because it's a little bit of a different flavour than I guess where we've been going with it traditionally with our market wraps, because things are starting to look slightly different than what I guess was expected. But look, let's start in the US. S&P down 2.47%. which is a bit of a change because everything was just going up in one direction only. There's a plug for the band. Not that they're into that. Totally off topic here completely. But S&P is down. S&P 500 is down 2.47%.
Yeah. So some negative news out of the US stock market, which we haven't seen for a little while. I mean, it's been very rosy, and sort of up until end of last year, things have been ticking along quite nicely, and market is down for the month, and that's all sort of pretty much due to one reason and one reason only, and that's inflation.
Inflation and the expectation around interest rates and where they're going to go. So, if we take a sort of small walk back in history, not too long ago, but we think about sort of where inflation had gotten to and the direction, in particular with the US, where it's going, and how the US lawmakers and Congress and stuff had managed to get inflation under control or towards under control. That was great. Everything was looking fantastic. But that last little bit of trying to get inflation within their target band is proving to be a lot more stubborn than what they would like. Hence the reason why we're starting to see a few jitters in terms of what's happening from an inflationary perspective.
Yeah, exactly right. So to put some numbers behind it, and to give a bit of context, inflation came in at 0.4% for month on month, and that was above the consensus of 0.3. Doesn't sound like a huge difference, but when you sort of factoring in what the market expectations are around interest rate cuts as a result of it, that's where things start to not look as rosy as they have been in the past, and that's why you're seeing the stock market really react to that news. So the market is pricing in. I mean, if you go back to sort of start of the year, market was pricing in that there would be rate cuts beginning in March. The expectation was that the Fed would be essentially dropping rates 7 times over the course of the year. Now, expectation is that rate cuts in the US are likely not to happen until September. And the market is pricing in that there'll probably be 2 rate cuts this year. So very big difference around what the interest rate expectation has been. And as a result, we're seeing equities responding to those news. But bonds on the flip side of it are...
Yeah, I mean, look, bonds from a bond yield perspective. So we're looking at the 10-year Treasury bond yield at 4.55%. That's been the highest since November of 2023, so last year. The reason why bonds are so important is because essentially it sets the risk-free rate of return when you talk about a US Treasury bond. 4.55, relatively speaking, is a fairly solid rate for assuming that you're not taking any risk. It's backed by the US government.
Yeah.
I think it puts it in some really good context, Andrew, when you talk about the month-on-month change of only 0.1, but then you look at it on the broader context around where's the interest rate expectation going to be. You're talking about 7 rate cuts to 2 and starting, 6 months apart. It's pretty significant. So, yeah, that's understandable why markets are starting to react and respond. Getting a little bit jittery around that. Andrew, talk to us about recession. We're seeing some recession signals pop up as well too.
Yeah, I mean, look, I think not for the first time, but definitely for what most people have been talking about in the past, or most people have been talking about recently. We haven't seen too much talk of recession.
Mm-hmm.
However, we are now starting to hear some of that conversation come into equities, and we're starting to hear economists talking about potential recessions and what that will look like. There's a million different signals, and people like to look in the past, but there are a couple of signals that have been a little bit or have caused a little bit of concern recently. One is called the Mel rule. So it's from BCA Research, so Bank of Credit Analyst, and they look at the unemployment data. We're talking about the US over here. So they're looking at the unemployment data, and it's risen 0.25% from its 18-month low. Now, if you go back to 1976, this is an indicator for every recession since. And so there's a little bit of concern that we are starting to see unemployment tick higher, and the rise in unemployment is generally a signal for recession, which is why, again, some concerns to talk about there. And Bill's SAHM rule.
SAHM rule. I'm glad you spoke about what the SAHM rule is, because I was wondering how you'd actually pronounce that, because it's written a funny way. But this is another rule, I guess, or a technical indicator. The 3-month average unemployment rate, if that rises 0.5% above and beyond the 12-month average or the 12-month low, that's an indication that we're going to see a recession. Now, we haven't seen that triggered or surpassed that threshold yet. However, it's starting to rise towards that point. So I guess if we look at it in an overall context, talking about where inflation was and then thinking, yep, we're going to enter into a recession, and then, policymakers started to do their thing. We spoke about a soft landing time and time again. Qantas. I was on a Qantas flight recently. Actually, I'm on a Qantas flight next week. So if you're listening, Qantas, make sure you chuck some sponsorship across our way. But so the soft landing looked like it was going to pan out, and everything started to respond accordingly in terms of markets and where that was going. And now there's a bit more uncertainty. So potentially talking about recessions again, I don't think it's cause for alarm, simply because that's where we were. We'll just wait and see how this thing plays out, I think.
Yeah, exactly right. And look, to think that we would come through this time period of, rising cost of living, high inflation, interest rates rising, putting pressure on households, to think that we would get through that without some turbulence, I think is overly optimistic.
Yeah.
And so the real thing to, the key takeaway out of this is, just as things were going incredibly well and you can't get overly excited, when there's indicators of potential recession, you can't get overly excited, just to remain level-headed throughout the entire time period.
Yeah, no, well said. China, nothing to see here. Move
Basically, on. Yeah, that's the big call out in the last month or so, is that we haven't really seen any major news coming out of China, which is neither positive nor negative. Maybe a little bit more concerning, given that we probably expected a bit more stimulus. We probably expected a little bit more in terms of news out of China, but basically nothing to see here.
Nothing to see here. Tick that box, move on. All right, let's move to the Australian market, because that's what everybody's interested in, I guess. So,
well, most of our listeners are interested in, at least.
That's what I was referring to. So ASX 200 was down 0.79% within the last month. Not surprising based on what we sort of spoke about at the top of the show with the US and what's transpiring over there. We're usually about 6 months behind in terms of where we're at, so that's not surprising at all.
Yeah, exactly right. So Australian market is basically responding to the US market. And similar story when you're talking about bond yields in Australia. I mean, they've also risen in Australia similar to what the US is, again, purely based off the expectation around interest rates and when we're likely to see interest cuts. I think that it's pretty unlikely that we'll see Australia drop interest rates before the US, so I think that we'll follow suit with the US market. And so if your expectation in the States is September, well then expectations in Australia, I mean, pick your time frame, but it's likely to be after that.
Yeah, and look, I think you're right. And if we talk about, or when we talk about the next sort of group of numbers, I think that really paints the picture in terms of what we can expect. So one of the things from an income perspective, because I guess inflation, how badly it impacts you, also needs to be spoken about in the same context of rising incomes. So in Australia, nominal income has been at 1% over the year until September in terms of income growth. However, inflation has been at 5.4. Now, just keeping that 5.4 number, that's been changing quite rapidly. Yep. So just keeping that in some context associated with that. But despite low unemployment in the country, we're still seeing that income has not kept up with inflation. So that's a really big challenge because if you think about that from a basic household perspective, stuff is getting more expensive or is more expensive and your income doesn't have as much purchasing power in order to keep up with that increased and that enhanced cost. So what do? You either reduce your consumption and your expenditure, or what do we do from a savings perspective, which is what we've been seeing?
Your savings, which is ultimately what we've been seeing is savings have really been eroded. People talk about COVID savings. I mean, there is a bit of, or was a bit of debate as to when that actually was expunged. But I think every economist is in agreement now that COVID savings is expunged, and so now we're dipping into savings, which is a cause for concern. And I think the real difficulty in all of this for households is, yes, you talk about inflation coming down. Now, when you talk about inflation coming down, you're just talking about the rise in prices slowing down. Yeah. But that doesn't mean that the price of goods have come down. So if your, box of cereal has risen 5.4% in the last 12 months, or your coffee, has increased by 5.4% over the last 12 months. Yep. If that inflation rate comes down to your target range and now all of a sudden you're looking at, 2%, that still means that it's increasing by 2% every year, your cup of coffee. Yeah. The only difference is that it's not increasing at 5%, it's increasing at 2%. And so until we start to see either a couple of things, but until we start to see deflation, so negative inflation.
If we see it.
Yep. Which is another cause for concern, because then you start talking about recession and all of that stuff when you're talking about negative growth. But until we see either that or we see incomes increasing and people's nominal income coming or increasing at a higher rate of what inflation is, there's likely not to be any relief from a cash flow side of things to households. Again, you throw into the mix, okay, well, inflation is still high, which means that interest rates are not going to come down as soon as what we expected. And where you saw households in the past expecting some relief, at least from an interest rate perspective, to come through sort of middle to third quarter of this year, you're now delaying that back even further, and it's really having an impact and an erosion on savings.
Yeah, and I guess when you play that out, that's a really interesting position that we can find ourselves in the economy, right? So if you've got a situation where we've got low unemployment, people are using more of their savings in order to keep up with just the pace of living. If we get into a recession and things slow down, unemployment starts to get impacted. People have got less savings, costs are higher. Yeah, it could really be a sticky situation that we find ourselves in if we don't navigate through this well. So it's going to be interesting. Not that this is a plug for our services or for the industry in general, but I definitely think there's going to be an increase in financial advice needs as we start to navigate through this. I mean, we've seen that in our own business anyway, but I guess if we've got a crystal ball, it would be plan now and start thinking about, what the economy, what your household, what your budget looks like in the event of a recession and a tick up in unemployment in particular.
Yeah. I mean, I saw an interesting statistic, and I don't have the numbers in front of me, so apologies for it, but we're talking about the US here. There was the number of people employed was actually lower, and the unemployment rate had actually gone higher. And what that was indicating was that people are starting to, because of the rising costs, need to take out second jobs, need to start doing, Uber driving on weekends or nights after they're finishing their normal full-time work in order to be able to plug the hole that's essentially in their budget. And I mean, one that's obviously, a thing that people need to do. But if you can tackle it from both sides, and on one hand, getting some additional income into the household, provided that it obviously meets your lifestyle needs, but at the same time tackle the expense side of things and make sure that you're really tight around any leakage on the expense. That's what's ultimately going to give you the best opportunity.
Yep. No. Andrew, a bit closer to home in terms of metals mining industry, what are we looking at from that perspective? There's been a bit of talk about that in the media in terms of, I guess, what's happening with the iron ore, not necessarily the price, but I guess the appetite from China in particular in terms of what they're thinking and what they're trying to do.
Yeah. I mean, look, we saw, and what we've spoken about is a bit of a reversal in the last week or so as to what we saw at the first quarter of this year in terms of or money market trends. But metals and mining were quite strong. So we saw the small resources outperforming. They were up, 2.85% in the last week. So we're starting to, or what's also starting to shift into the market is precious metals are starting to really rise in price. So we're seeing gold prices increase as a result of it, and those miners doing quite well off the back of it. So generally signs of concern in markets. I mean, a lot of people move towards precious metals when there's concerns around investment markets, but that would be a trend that you'd expect. I mean, when you see the US market down, the Australian share market down, you tend to see the precious metal market up as a result of it when people put money in there as a hedge to those.
Well said, well summarised, Andrew. Hopefully that was a short, sharp market wrap for our listeners and our viewers. Hopefully you got a fair bit of value out of that. As always, if you want any further information, reach out to the team at 360 Financial. Andrew, thank you once again.
Thanks, Bills. Thanks to all of our listeners. Like, subscribe, and look forward to catching you on the next podcast.
Cheers.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaridis and Andrew Nicolou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.